In the old days, if you couldn't get a loan from a bank, you went to a loan shark. Now, it might be with some crazy rates and some shady people, but you got the money quick. But if you didn't pay on time, well...
Give me the money, you hear me? Give me the money.
But today, you don't need to risk broken legs. You just need a suit and an address on Wall Street.
This is the private credit market. It's now valued at around $2 trillion.
Private credit is growing not just because rates are higher and therefore investors want more of it.
So how did private credit become a $2 trillion empire without anyone hearing about it? After 2008, banks faced stricter regulations and were forced to pull back on risky loans. So private equity firms who traditionally borrow from these banks suddenly had a problem. Where do we get the cash to buy companies with? Well, that's exactly how and where private credit comes in. Here's where it gets dangerous. The biggest private equity firms have now joined forces with private credit, so now they're sitting on both sides of the deal, supplying the money to buy companies and the debt to finance those purchases. And once you control both sides, you don't just have the power to hide losses and delay risks, but the power to control the nation's credit and the power to write your own rules. But if that hasn't terrified you yet, the money that's fueling all of this, it's yours. And you had no idea about it, just like you didn't know about 2008 until it was too late.
When you see one cockroach, you'll probably see more. Those comments now have private credit.
So to understand how private credit is quietly changing who controls the lifeblood of the economy, we first have to understand what exactly they're doing and how they're slowly becoming as powerful as the banks. And it all started by filling a hole in the market. Because after the 2008 crash, there was bank reform. This meant less capital for leveraged buyouts that private equity firms relied on. Look, I've already talked a lot about private equity in my previous videos, but in short, private equity firms buy out entire companies to then sell them later for profit. And they do this by taking on massive debt that the company that they bought traditionally absorbs, or in short, it's called a leveraged buyout. But since banks were now less willing to fund these sorts of ventures, this is exactly where private credit stepped in. And companies that were either too small or already had too much debt went to private credit. It turns out private credit had few big advantages. One advantage is that they don't face the same regulations that banks do because, well, it's private, which also meant that deals were done way faster and with way less paperwork that would usually be required for million-dollar loans. So it was a win-win situation because lenders got access to credit and investors got that sweet, sweet yield with low risk. Namely, insurance companies, universities, and even pension funds, which I'll get into later. Because besides these investors, where is private credit getting all this sort of money to fund these deals? Well, remember how I told you that private equity firms were the main users of private credit? Well, it turns out is that a lot of private equity firms are also private credit firms. In fact, the top 10 private equity firms now control about 1/3 of all private credit assets. Like in 2023, when Apollo and Blackstone joined forces to finance Carlyle's $5.5 billion buyout of a healthcare tech company. It was the largest private credit deal ever recorded, all made possible without a single bank in sight because they became their own bankers. But how is this not conflict of interest? Well, good question. Here's how this works. For example, when Blackstone arranges a loan from one of its credit funds to finance a buyout from one of its own equity funds, on paper, it's two separate entities with different investors. But economically, it's Blackstone negotiating with Blackstone. So the same parent company sitting on both sides of the table. So in theory, this can improve efficiency. But in reality, when you start blurring the line between the two, there's obviously plenty of opportunity for financial manipulation. Since these companies owe money to themselves, they don't actually have to pay back the interest when it's due. They just say that they'll pay it next year. Or another thing they do is they simply add the unpaid interest to the existing loan, a trick known as payment in kind interest. So let's say if a company borrows $100 million at 10%, after a year it owns $110 million. And next year the interest is charged on that bigger number. And it snowballs where more and more debt is quietly compounding in the shadows, even if it looks all good on paper. And by the way, this is all perfectly legal. And I think a big reason why nobody seems to notice is because they made sure it stays this way, where the lines between owner and lenders have blurred to the point of invisibility, and a single company is now sitting on both sides of the deal behind closed doors. But you might be thinking, why the hell should I care? Well, let's say one of the companies that private equity owns and private credit funded starts getting in financial trouble. Now what happens? Which debt takes priority? Is it the lenders or the equity owners? In fact, it doesn't really matter, because no matter the priority, it will come down to which companies get rescued, which get scrapped, and which workers keep their jobs. Because as I mentioned, what private credit is doing will impact you. And when they can keep that truth behind closed doors, you won't even know it until it's too late. Because when private equity takes over, the company may look the same on the outside, but then you start seeing some worrying symptoms. And especially with private credit in the deal, some might even call this like a financial virus, but it's not in the way that you might obviously think of. Instead of companies just going bankrupt after a takeover, what we're instead seeing is a growing number of these so-called zombie companies, where these companies are so overloaded with debt, they can't grow, they can't innovate, and sometimes can't even pay their interest bills. But because of private credit's financial engineering, these zombies are being kept alive because private credit don't want their hosts to die. Because how else will you keep collecting those sweet management fees if the company goes under? So that's what's happening, but here's how this infection can spill over to the entire economy and you watching. Because if a recession hits, that fragile network of zombie companies paying millions in interest could all snap at once, unleashing a wave of defaults that can impact you. When Toys R Us collapsed in 2017, it was paying $400 million a year just in interest. And when the company died, 33,000 people lost their jobs overnight, and that's just one toy company. In the US retail sector alone, more than 3 million workers have lost their jobs in the last decade after private equity takeovers. But even if your own company doesn't get gobbled up, you can still feel the impact. In healthcare, private equity's debt-fueled buying spree has turned hospitals, nursing homes, and clinics into profit engines. And studies show that these sorts of hospitals routinely raise prices while the quality of service remains stagnant at best. And I made videos on all this, but even housing, where private equity is increasingly buying up hundreds of thousands of single family homes and turning them into rentals. So that more that private credit and private equity work together, this does have a direct impact on you in the community, where the stores vanish, the hospital starts charging extra, and the rent that keeps rising. But if that wasn't bad enough, what if I told you that you're the one that's actually funding it all? The money that fuels private credit and private equity isn't just billionaire capital. It's pension money, insurance money, university money, like I mentioned. To be fair, if you're managing these funds, you would do the same thing. During the boom years, private equity returned about 15% annually, far better than the stock market. But these returns come at a price. Sure, you might get a slight bump of your pension, but at the same time, you'll be paying extra on your hospital bills or rent. And here's something else to consider. Leverage is a results multiplier. It turns good times into great times and bad times into total disasters. So the very force that made private credit so profitable in the boom years could make it catastrophic in the next downturn. If interest rates stay high or a wave of defaults hits these zombie portfolios, the pension funds could be the first to feel the impact. And it's already happened before. The Pension Benefit Guaranty Corporation found that between 2001 and 2014, bankruptcies wiped out about $128 million in benefits for about 100,000 workers and retirees. So yes, grandma's pension grows when Blackstone or KKR succeed, but when their bets do go wrong, the pain can echo right back through the very system that financed them. And with the rising interest rates and increased risk of defaults, you think that the people would wake up and the money would stop pouring in. But that's the exact opposite of what's happening. Because here's the thing. Whoever decides where money flows, like who gets funded, who gets refinanced, who gets left behind, effectively decides what kind of economy we live in. And when private credit is increasingly controlling that flow, power shifts from public markets and regulators to financial empires operating in the shadows. So this raises the question, if it's already this powerful, what happens if it keeps growing? Because private credit isn't just controlling both sides of the deal now, they're increasingly coordinating with a select few. When Blackstone's private credit arm lends to a company that Carlyle's private equity division is buying, both sides have a shared interest. Keep prices low, keep the loan safe, and keep the deal within the family. So the same firms that once fought and competed over deals, which you and I can agree is what makes capitalism great, now builds and coordinates together, and they're making sure that it always stays this way. And their lobby group, like the American Investment Council, that's working overtime in Washington, or are they? In 2024, the AIC spent only about $2.67 million on federal lobbying. So I think you and I can agree that doesn't really seem that like much. But consider the fact that in the same year, 34 out of 44 American Investment Council lobbyists have previously held government jobs. And a year before, it was 35 out of 40. Classic example of the revolving door policy. And add in the fact that these funds now control trillions of dollars of assets under management, and you can clearly see how they're having a disproportionate influence on politics. And so what I'm about to say is obviously just speculation, but maybe they don't really need to throw that much money because things just happen and work and they get their way. Now, to be fair, the regulators are sort of waking up to the problem. In 2023, the SEC proposed new rules to make private funds more transparent, and the regulators in Europe are raising concerns about non-banks doing bank stuff without any clear oversight, but that's mostly just talk. Because it's pretty naive to assume that the politicians are going to change a system that's directly benefiting them. They want another job once they're booted out of office. So what's clear is that this $2 trillion shadow banking empire have also learned from the mistakes of banks. Because while regulators have been slow in catching up, private credit has been studying the past. They didn't just find the gaps that banks weren't fulfilling, they also found the legal gaps that allow them to avoid the same regulations that banks are subjected to now. And it's exactly why I tell you guys that you need to learn how money and power works, because just like in 2008, you watching won't know the actual risks and potential consequences until it's too late. So the question is, where do we go from here? So just to be perfectly clear, not all private credit is evil. It's the same way it's a dumb thing to just say that private equity equals all bad. Because truth is, private credit models have financed companies that traditional banks would have ignored. They filled a need in the market, and it's helped some businesses stay afloat, and it's also clearly delivering higher returns to pensions that badly need them. But at the same time, inflated valuations and bad debt can only be hidden for so long until the cracks start showing. And if the domino effect leads to a total collapse, that damage won't just hit Wall Street, but it will ripple through the same pensions, towns, and jobs that help fund the machine in the first place. And to give kind of a break to the regulators, they are stuck between a rock and a hard place. If they crack down on private equity too hard, they risk cutting off a source of capital that has become essential to modern businesses. But if they do too little, the risks do keep compounding until something inevitably breaks. And so taking all the good and the bad of private credit, the question becomes, is this sort of the future we want, where more and more and more a select few privately control the nation's flow of credit? But maybe it has always been that way. Back in the Gilded Age in the 1900s, JP Morgan's grip on the nation's credit was so tight that when the economy started breaking, the government actually had to ask him to help bail out the country. And a century later, we're seeing similar history repeat itself, but now with a select circle of faceless asset managers. Only this time, the money moves faster, the networks are global, and the oversight is weaker. So if it comes crashing down, will the price we pay be a lot higher too? So to answer that question, I will be diving even deeper on this topic in my free weekly newsletter next week in the video description. But if you'd rather learn more about private equity that I mentioned throughout this video, I think you will want to watch this video next.